Britain's millionaires have written to the Prime Minister with an unusual demand: tax us more. Which sounds admirable until you ask one simple question: would they actually pay it? The letter was signed by 120 UK millionaires and backs an annual tax of 2% on net wealth above £10 million. Supporters say it could raise £24 billion a year. That is serious money. But before deciding whether it is fair policy or expensive virtue signalling, we need to define what millionaires mean in the context of a wealth tax. A millionaire could be somebody whose family home rose sharply in value and whose pension built up over 40 years. It could be a disciplined saver and passive investor accumulating assets to £1 million, a founder whose private company is valued at £15 million, or somebody worth £100 million with enough capital to generate more each year than an ordinary worker could earn across several lifetimes. They're all different financial profiles, but defined as a millionaire. Under this proposal, everybody below 10 million is not part of the tax. That's more or less fair. The homeowner made a millionaire by absurd housing inflation is not the target. The disciplined worker who saved and invested to 7 figures after 40 years is not the target either. Being called a millionaire does not even tell us whether a signatory would pay. The headline has compressed several economic worlds into one convenient word. The real argument begins when you compare wealth with work. An employee's salary is difficult to hide. Income tax is removed through pay. National insurance follows. Above £100,000, the personal allowance is withdrawn, creating an effective 60% income tax rate on part of the salary before national insurance. The hardworking person suffers as they climb their careers naturally. A person earning £120,000 is doing well, but they still exchange time, skill, and employment for income. If the job stops, the salary stops. Capital is already taxed through gains, dividends, inheritance, and property. Wealth is not something government has forgotten exists, but the treatment is fragmented. A salary is taxed as it arrives. An asset can appreciate for years without being sold. The return on an asset compounds faster and harder the more it grows. Capital gains. Tax then comes to collect the bill if and when it sells. The headline capital gains tax rate for a higher rate individual is 24%, while employment income can reach 45% before national insurance. A person sitting on wealth can genuinely pay less tax than someone working their heads off. At the same time, asset wealth can generate dividend income too. That adds to accumulating wealth even more. The rules aren't universal. Calling it inconsistent is an understatement. Now to go even further, look at what extreme wealth can do by itself. Take £100 million and assume a 5% annual return. That produces £5 million in a year before fees and tax, about £13,700 a day. Median gross annual pay for a full-time UK employee is roughly £39,000. It would take around 128 years of that salary to earn £5 million. And that's before the taxman collects the bill. That is why percentages become misleading at the top. A £100 food shop has the same cash price for everybody, but it's not the same living price for everybody. For a household living from salary to salary, essentials decide what is left. For somebody whose assets can generate millions in dividends and capital gains alone, dropping £100 on the floor is like dropping loose change. That does not make every wealthy person idle or undeserving. Many built businesses, took risks, and created jobs. It just means extreme wealth creates a different level of playing field with the salaried earner, one that people argue isn't entirely fair. The wealth tax reintroduces fairness, but it isn't tiny. It is 2% of wealth above £10 million, not 2% of the owner's annual return. Somebody worth £12 million would pay £40,000. At £100 million, the bill would be £1.8 million, because the first £10 million is outside the charge. If that fortune returned 5%, the tax would consume 36% of the entire £5 million return. It would leave £3.2 million before existing taxes, fees, and other costs. I'm not saying that person is being pushed towards a food bank, but £1.8 million is not a small sum either. And if the assets have a flat or losing year, the tax still arrives. The losses can magnify harder for wealth than for salaries. The proposal should be targeted, but also can't be super painful. Then comes the obvious question. If these millionaires genuinely want to pay more tax, why do they not simply send the Treasury a check? They can. HM Treasury accepts voluntary payments. The money cannot be reserved for a favourite service and cannot be reclaimed. We do not know from the letter which signatories have made voluntary payments, so accusing all of them of hypocrisy would be lazy. But asking is fair. A contribution would show the principal survives contact with their bank account. It still would not replace a tax. The economic problem is collective action. If one wealthy person contributes while everybody else keeps the benefit of the existing rules, the volunteer pays and their peers do not. Each individual has an incentive to wait. Taxation changes the game. It creates one enforceable rule for everybody inside the group and gives government revenue it can plan around. So why not donate? Tests sincerity. Policy creates accountability, and policy is where things can start to become difficult. Listed shares have market prices, houses have limited amounts of comparable sales, private companies, partnership interests, art and trusts are harder to put a value on accurately. Private businesses can be assessed using earnings, cash flows, assets, or comparable companies. Britain already values difficult assets for other legal and tax purposes, so valuation is not impossible. But a rough rich list estimate is not automatically good enough when an annual 7-figure tax bill depends on it and the taxpayer can downplay the number. A lot of extra effort and public resources could be needed to just validate the accuracy of the valuations. That's spending more money the country already doesn't have. Then there is liquidity. A founder could own a small business valued above 10 million, but won't be holding enough spare cash to pay every year. What happens in this scenario? The tax can be designed. Strong design is the entire argument for the tax. A workable law needs exact definitions of wealth, debt, beneficial ownership, trusts, residency, valuation, deferrals, and exit rules. It needs strong information powers, appeals, and few exemptions. People facing a 7-figure bill can afford very good advice. Tax law cannot rely on a powerful slogan. It needs powerful sentences that still work after the lawyers arrive and stop the loopholes being exploited. And then government has to spend the money properly. £24 billion would be meaningful. If the full estimate arrived, it would equal roughly 1.7% of expected public spending this year. That can fund services, relieve other taxes, or repair the state. It cannot rescue every service and transform living standards alone, but it will alleviate pressure for sure. A badly designed tax feeding inefficient spending would achieve little beyond another bureaucracy. A well-designed reform used on clear priorities could make a genuine difference. So the verdict should not be millionaires good or millionaires bad, nor should this debate drag homeowners with a valuable property, disciplined savers, or employees on high salaries into an argument about extreme wealth. They are not the same as extreme wealth. An annual wealth tax would be difficult to value, costly to administer, and vulnerable to avoidance. At 2%, it would take a substantial share of normal investment returns. Those objections are serious, but dismissing it as an attack on ordinary success is intellectually lazy. Everybody below £10 million would pay nothing, and somebody earning a strong salary through work is not living the same economic reality as somebody whose assets can produce £5 million in a year. Britain is already extremely good at taxing the next pound somebody earns by working. It should at least be capable of levelling the taxation of the £100 million somebody already owns. The target is ultimate wealth, not ordinary success, not disciplined saving, and not the employee whose payslip has already been slashed by the tax system.